Welcome back, everyone. Today, we are bringing you a rapid-fire explainer designed to completely solidify your grasp on core bank customer relationships and, of course, regulatory compliance. Look, if you're gearing up for the JAIB PBB module, you know exactly how dense this material can be, right? Well, our goal today is to cut through all that noise, structure the concepts, and get you ready to clear this module with absolute confidence.
Okay, let's dive into this. Here is our roadmap to lower your cognitive load before the exam. Core banking definitions, bank customer legal relationships, KYC and due diligence, AML and reporting rules, and finally, handling special scenarios.
Let's jump right into Section 1, Core Banking Definitions. We absolutely must start at the legal bedrock here.
Okay, so Section 5B of the Banking Regulation Act 1949. This is literally the foundation of everything a banker does. It's not just about taking money. It's the act of accepting deposits from the public specifically for the purpose of lending or investment. And crucially, those deposits must be repayable on demand, like when a customer walks in with a check, or otherwise. Along with the authorized activities outlined in Section 6, this is your baseline. Every single service you offer, it branches out from this exact definition.
Moving along to Section 2, Bank Customer Legal Relationships. Pay close attention because this is an absolute goldmine for test takers.
Let's walk through these systematically. You'll notice how the legal relationship completely flips depending on who's actually holding the money or the asset. So when a customer makes a deposit, the bank is the debtor who owes money, and the customer is the creditor. But issue a loan and boom, suddenly the bank is the creditor and the customer is the debtor. It's all about possession and purpose. Rent out a locker, you're looking at a lessor and lessee relationship. But, and here's a fun one, if you're holding an article in safe custody, the bank becomes the bailee, holding the item in trust for the bailor. So no, you absolutely cannot borrow their diamonds for a weekend gala. And for check collections, the bank is simply acting as an agent for the principal, which is the customer. You gotta memorize this flip.
Let's anchor these abstract legal concepts with a real-world scenario. You might remember the famous Subramaniam Pillai case. Picture this. A customer deposits money explicitly as a guarantee to purchase a vehicle. But before the vehicle is delivered, the bank unfortunately fails. It goes into liquidation. As a banker, how do you legally classify that specific deposit?
So, the crucial point is, the bank does not act as a standard debtor here. Because the money was deposited for a highly specific purpose, a guarantee for a vehicle, the bank actually acts as a trustee, and the customer is the beneficiary. Why does this matter? Well, during liquidation, instead of just getting a fractional dividend like regular creditors, this customer is entitled to a preferential refund. The money was held in trust. It's a real game changer.
Now, I want this number burned into your memory, 100. This is a massive, massive exam trigger, specifically regarding safe deposit lockers. Under the latest RBI locker rules, if a customer's locker contents are lost due to a shortcoming, negligence on the bank's part, or an employee-assisted fraud, the bank's liability is not zero. The compensation is exactly 100 times the prevailing annual rent of that safe deposit locker. That is a huge hit. So, speaking directly to you as a banker, when you open a locker for someone, always remember the heavy financial liability tied to this lessor/lessee relationship.
Okay. Here is another practical branch scenario to test your understanding. Imagine a customer misplaces their original fixed deposit receipt and comes to your desk asking for a duplicate. It seems like a simple administrative task, right? But legally, who assumes the risk if someone else finds and cashes that original receipt?
Well, before you ever issue that duplicate, the customer has to sign an indemnity bond. In this setup, the bank becomes the indemnified party, meaning protected from loss, and the customer is the indemnifier. Basically, the customer is explicitly promising to cover any financial losses the bank might suffer by issuing that duplicate receipt if the original suddenly surfaces.
Let's shift gears to Section 3, KYC and due diligence. Flawless onboarding is a regulatory non-negotiable.
Now, what's really interesting about this next concept is that it revolves around another highly testable number, 14.
When we deal with the Central KYCR Repository, or CKYCR, every single profile generates a unique 14-digit identifier. But here's the critical regulatory hook, so listen close. While banks can download and rely on these centralized records to onboard a customer, the ultimate responsibility for the verification rests entirely on the bank that last uploaded and updated those records. If another bank downloads your flawed data, it's completely on your head.
When verifying identity, there are exactly 6 officially valid documents, or OVDs. Let's rapid-fire through them. Aadhaar, passport, driving license, voter ID, the NREGA job card, and the National Population Register letter. I absolutely must warn you here because exams love to trick you with this. A ration card is never considered an OVD. It might get you grain, but it won't get you a bank account. Don't fall for that trap.
Next up is the KYC refresh cycle, which is dictated by the customer's risk category. The easiest way to lock this into your brain is a simple mnemonic. Just remember, high, medium, low equals 2, 8, 10 years. If a customer is high risk, you must refresh their full KYC every 2 years. Medium risk, every 8 years. And low risk, every 10 years. Easy enough, right?
All right, moving into Section 4, AML and reporting rules. This is where we get into the serious legal weight of the Prevention of Money Laundering Act.
Let's move to this sequence and see how it builds the entire life cycle of dirty money. Phase 1 is placement. This is the most vulnerable stage where illicit funds are physically introduced into the legitimate financial system. Phase 2 is layering, complex, multiple transactions used to distance the money from its illegal source. And Phase 3 is integration, where the laundered money is successfully mixed back into legal economic channels, appearing entirely clean. Our job? Stop at a placement.
Now, a key part of anti-money laundering is identifying a politically exposed person, or PEP. Think high-profile foreign individuals like heads of state or senior politicians. Identifying a PEP immediately triggers mandatory high-risk protocols. You can't just do standard KYC, you must perform enhanced due diligence, or EDD. This requires continuous transaction monitoring and, as we learned earlier, that mandatory 2-year KYC refresh cycle.
When you spot red flags, reporting to the Financial Intelligence Unit, India, is time-critical. Standard volume reports, like cash transaction reports, cross-border wire transfers, they all get a 15-day deadline after the month ends. However, notice the stark difference for a suspicious transaction report, or STR. That demands a strict 7-day turnaround from the exact moment you conclude the activity is suspicious. 7 days. Whatever you do not miss that deadline.
And finally, Section 5, handling special scenarios. Let's do a quick lightning round of tricky exam questions.
Here's the scenario. Mr. Sharma has autopay standing instructions set up for his electricity and insurance bills. Unfortunately, he passes away unexpectedly. His relatives argue, hey, the bank should just keep paying the bills automatically. The instructions were already given. Can the bank legally continue processing these payments? Think back to our legal relationship mapping from earlier.
The answer is a hard no. Actually, let me clarify that. It's an instant termination. With standing instructions, the bank is acting as an agent to Mr. Sharma, the principal. Under the Indian Contract Act, the moment the principal dies, that specific agency contract is instantly voided. The bank's legal obligation to make those auto payments terminates immediately.
So, you now have the structured playbook to clear your JAIIB PPP module on the first attempt. But beyond the exam, ask yourself this. The next time a customer walks into your branch, are you just seeing a routine transaction, or are you seeing the complex underlying web of legal liabilities tying you together? Keep that perspective, and you won't just pass the test. You'll be a substantially better banker. Thanks for joining us on this explainer, and happy learning.